I wanted to make another pre-recorded video, not to demand too much of your time. And the point of this video is to add some perspective from a higher time frame, zoomed out point of view, because I think we're in a type of regime where that type of thinking isn't rewarded, right? We're always, the market is getting completely whipsawed and jerked by headlines and a lot of algo trading, and not just around geopolitical headlines, but also we've noticed an increase in the prominence of the US equities open or the cash session, whatever you want to call it, just US trading hours. We've also, in the last month or two, had the whole coupling, decoupling meme, which is to say the correlation with US risk indices, specifically the NASDAQ and the S&P 500. Crypto traders, more than ever before, are forced to care about macro stuff, again, as a product of the increased correlation with the S&P 500, but also just in general, having been a large beneficiary of the quantitative easing and easy money and infinite liquidity as a result of the unprecedented monetary and fiscal interventions taken up by central banks across the world. We had a really good time with that at the expense of other parts of the economy, to say the least. And now that the Fed and the Federal Reserve and central banks in general are changing their sails, to say the least, and there's quantitative tightening on the horizon and inflation appears less transitory and more sticky than first thought, the basic premise is that interest rates must rise, and at least in the short term, and especially while there's uncertainty surrounding the rate at which interest rates increases will go, that's bearish for risk assets, and that's only being compounded by the geopolitical headlines that are whizzing around the world as well. You can see that in, single names in US equities like Meta and PayPal, and a lot of the SPAC IPO garbage just completely disappearing. You can also see that in commodities prices. It's just a bit of a whack market. And I think that's also understandably led to a lot of very short-term thinking as people try to squeeze the market for all it's worth, usually in the form of very low time frame trading, leverage trading, or essentially trying to make back all the unrealized P&L they were sitting on at the highs without the same easy market and infinite altcoin trends to facilitate those returns. And it's in this type of environment where, you'll spend lots of time surgically analyzing the difference between 37K and 33K as a level. And is there a trouble area at 35K and all this micro-analysis? And there's a real risk of losing perspective and losing sight of the so-called bigger picture. I know it's very cliche and, the utility of this is questionable perhaps, but as I posted on Twitter, I do think even this will blow over. I don't think this will be the market forever of us just getting dragged down by macro spillover, geopolitics, inflation, all of this stuff. That I think is transitory, that we're in this extreme PvP, non-crypto led momentum, if you will, type of environment. Now, it doesn't mean it's going to end here. It doesn't mean it's going to end soon. Those types of prognostications are certainly beyond my remit. But I doubt that this is some sort of permanent fixture, even if stuff continues to go down, chop, whatever it may be, right? It's probably not going to be the case forever. Now, with that said, I think it's useful to get some high time frame perspective, and I just want to quite outrightly outline the two reasonable bullish ways to position for strength. I mean, that's redundant, but whatever. The two ways of being bullish Bitcoin that makes sense to me. I think there are one of two scenarios. Both could be true, whatever. But here's the framework. I just want to move away from the low time frame stuff just for a moment and talk big picture. Here they are. Okay. So the first option is 30K holds. Now, that may seem self-explanatory, but the base case for being bullish at 30K is essentially that just like all the very urgent, and you can see that the way the market dropped from 60 to 30 on the Elon plus China FUD, if you want to call it that much, as opposed to the very kind of regimented and more programmatic, less liquidation-driven selling that we had from the more recent high. There are clear microstructural differences between those moves. But in any case, the base case for option 1 is that 30k holds. Just like this absorbed all the bad shit happening in the world at once all together, the premise is essentially similar, that 30k will do so once again. Now that may seem self-evident, but the reason I bring it up is because how that trade unfolds, if it does unfold, if you're too focused on the low time frame stuff, you may risk missing the forest for the trees or the trees for the forest. English isn't my first language, so I always get that idiom wrong. But in any case, for example, it could be as straightforward as you take this cluster, and however long the reaccumulation takes within this cluster, you are a buyer within that price range, and ideally trying to get your average as close to the bottom of the range as you can. So like a low 30 average in general. And the premise is that if anyone needs to sell, or any urgent selling, or any kind of worst case scenario, essentially holds this area. Now, how does that look? Could it be as simple as, the market just finds support somewhere there, then goes up to the mid-range and consolidates there, higher, low, all this type of structural stuff? That's completely fine. However, it could also be the case that the market makes an earnest attempt to break down below 30k, and say you even get a bit of an exaggerated move which swipes or spikes these previous year's lows, and then gets violently rejected, and then you just get chop before some sort of move up much later. Whatever that trade structure looks like, and this is where the shorter term and more frequent streams come into play. We can actually describe price structure itself, right? Maybe it's per Don's box, for example, like just a retest of this support, or even, as mentioned, some version of a failed breakdown of that support into a reclaim. You can see there are many ways to chop this onion, but one of the bullish scenarios that's worth bearing in mind is essentially the premise that 30k holds, and by extension, you do not get a retest of 2017 or previous all-time high levels. So no matter how bad it's going to get, the worst you have to stomach is 30k getting poked out or spiked, wherever it may be, and then the assumption you're making is that there are enough kind of value buyers for BTC, enough of a cash backstop at that type of price and market cap to be able to support prices and absorb all the selling from the puke and equities, the momentum sellers, whatever it may be, right? 30k holds, that's the premise, and then really, if that argument is correct, the only part that you'll have to swallow is most likely the shitty price action and volatility that accompanies it before the market kind of enters some sort of reaccumulation, more sideways. And then as the very serious headwinds that we're facing at the moment clears up, you get some sort of mid-range retest of resistance at 46k. And then your target, if that breaks, is ultimately a move back towards the range high at 60, 70, 80, whatever it may be. But again, one way in which the market may bottom, and again, this isn't making a prognostication as to how that price structure will look, or how long it will take to resolve, or how long it will take to make new highs even after the bottom is put in. That's a really important one that people get mixed up. Just because the market puts in a bottom doesn't mean it's going to rally from that price or move away from that price very quickly. Like, even if we take some extreme examples, the 6k to 3k breakdown, even after the market bottomed, the grindy price action that preceded it, I should say, was absolutely awful to stomach. Like, the best entry isn't necessarily the lowest entry at all times. Even if we take the 2020 March crash, you basically had months of rather agonizing price action that I'm pointing to here before you finally got a break in market structure and a move higher. So while at first glance, this whole 30k holds premise may seem super straightforward and easy to interpret, it isn't, because it could happen in a bunch of ways, but that's really one scenario that's worth bearing in mind. TLDR, 30k, once again, is able to absorb all the FUD. That ends up being some very magical value area for BTC where, everyone who wants to sell has already sold, and it's cheap for these large crypto funds or value buyers, allocators, whatever. And yes, you get some spikes and some crappy volatility, price action that's not nice, but TLDR, the market manages to hold that area, right? And again, this is a kind of macro position trader type of video. And, the move from 28 to 31, if that's your framework, or from 32 to 39, or price consolidating between 30 and 40 for 3 months, those things are immaterial essentially to that thesis. Now, the second one to bear in mind is the market meltdown generational opportunity, which is essentially the opposite of the first premise. And the easiest way to describe premise 2 is that it's essentially the 6K breakdown at 30K, which is essentially where the market creates a very large, very significant, all eyes on deck level at the range low, which seems like it's free money to buy every single time as volatility continues to contract, right? So bounce from 30, bounce from 30, bounce from 30, and you get decreasing volatility as the recurring touches continue until you get a volatility expansion to the downside, and that expansion tends to be pretty meaty and pretty significant. Very hard to get on board that type of move unless you're comfortable with uncomfortable entries, to say the least, or chasing momentum far away from the breakdown level. But on average, I don't know, eyeball kind of a 30 to 50% decline from that major level being broken. And the type of headlines or events or macroeconomic environment or the state of the S&P 500 or risk assets generally, like the world would have to be in a pretty messy place with a lot of surprise in the market, frankly, in order for that scenario to come to fruition. However, if there's one thing I learned from trading crypto after all these years, is to never fully discount even the tail events or low probability events. And that's why I think whichever one of these you're trading, I think employing leverage is pretty dumb. And this is kind of at least my framework for spot. So what that would look like, the market meltdown is the first half, which is essentially 30K is the new 6K, volatility contracts, support gets beaten up until eventually the value buyers get run over and the market pukes significantly, sort of 30 to 50%. Now, what would be the target for that type of downside move? I think we just have to essentially use the eye test for that type of thing. I think the monthly is surprisingly helpful, at least to give us a rough area. Let me turn on long just to make the levels a bit better. And this could be as simple as looking at candle structure as to, if you get a breakdown of that type of magnitude, which is very significant, where can you reasonably expect those value buyers or whoever it's going to be to step into the market? And my eye is drawn to the last kind of meaty portion of trading in this market before we went parabolic or completely crazy uptrend. And that to me is sort of ballpark, 12 to 14K, with the first kind of pure TA level being 20K as the prior all-time high. Now, again, from a position trading point of view, the exact entries and structures matter a lot less. But what you can kind of see is with these two scenarios, like where does it make sense to be bullish Bitcoin, or at least start entertaining bullish cases for BTC? One is that 30K holds in some form or another. Is it going to be tap support and teleport? Is it going to be consolidate between 30 and 40K for absolutely weeks and months before breaking? Is it going to be a failed breakdown attempt below 30K, which gets automatically bid up, and that's your deviation, and then it's a matter of stomaching volatility? Nobody knows, and I can't tell you the answer for that. But the overarching theme is that we're just way too past this era of BTC trading. Even if macro looks like shit, headlines, geopolitics, yada yada, those urgent sellers will be absorbed in the 30K area. And whether it's 32 or 28.9 doesn't matter all too much. And obviously, the second premise of market meltdown generational opportunity is essentially, as mentioned, that it's not enough for the market to bounce at 30K, and the headwinds are too heavy, and the value buyers do get run over, and the range breaks, whatever it may be. And in the absence of that being some sort of deviation or some sort of failed breakdown, I really think we have to entertain the idea of kind of a 30 to 50% correction from the range low. And at least for me, the eye test, my eye is drawn to anywhere from kind of 14, sort of 12 to 14K at an extreme, with 20K being the first real technical level. Now, again, obviously, I think the first one is more likely than the second one, but that's not to say that the second one should be discounted by any means. Hence my insistence on not using leverage for that type of move unless you're really sure, or after the deviation has already taken place, so you can at least define that way. So I think for most people, the base case is 30K holds in some form, and the market ranges for a year between 30 and 60K. And we've already seen the midpoint of that range tested at 46, 47. I think that's a totally reasonable base case, as long as you're aware of what happens if that base case is wrong. And the reason I mention this is because I remember when 6K broke down, that was unfathomable to a lot of market participants. But the worst part of it is, and perhaps is the most valuable part of the video, is that participants were trying to knife catch the 6K break as if it were going to resolve very quickly. You can even find a tweet, I'm sure, from 2018, whatever it was, where my argument was, don't try to knife catch the 6K break, try to buy it when 6K gets reclaimed. Right? And that certainly aged well, because you saw a lot of people trying to buy 5.8, 5.6, 5 point whatever, and all of those buys were completely wrecked. And by the time price got to 3K, no one had any dry powder, and they're down 50%. Right? So this is a bit of a weird video to make, because it's not exactly like a trading setup video per se. As I mentioned, the way 30K can hold can take many forms. And, we've only have essentially 1.75 months of price action trading at a monthly level. We could spend much more time here. We could spend much less time here. Maybe we get some asynchronous news event. Maybe derivatives get really aggressive and we see negative funding get absorbed. Like, there's so many things coming into my head which fall under the general umbrella term of 30K hold. So there's no point of me drawing squiggles or drawing patterns, because it could happen in a million different ways. But from a positional trading point of view, that's certainly one of the ways the market can bottom, as long as you can survive the relative vol, both at the extreme, if it's some sort of failed breakdown, capitulation wick that gets absorbed, spike, yada, yada, on one side, and then you are also able to survive the boring chop volatility that would follow such a crappy event. On average. That's what I mean by both sides of the vol spectrum, right? You don't get blown up on the large move, and you don't lose all your money trading the chop or getting rid of good positions when vol slows down. If that's wrong, a lot of the market will be wrong and will end up in positions that for them seemed completely unfathomable. So the 6K break for a lot of crypto participants in 2018 or wherever that was unfathomable. I know, because I was there, and that felt like a pipe dream, right? So in the same vein, if one doesn't work out, you have to have a plan for two, because people who actually have cash or have some sort of something to throw at the market on the type of significant event of that, an event of that type of caliber, that's only really going to happen like once every few years at most, I would imagine. Amongst all this unprecedented macro inflation, geopolitics, infectious diseases type of crap, you want to be in a position to get those, as I say, generational opportunities. And for me, if you get a real break of 30K that doesn't turn into some sort of deviation, failed breakdown, etc., one of the worst things you can do is to try to fade that expansion, in my opinion, and knife catch it outside of really good evidence of absorption or even the market trading back within the range. And if it's the case that you get a 6K-esque style breakdown and the macro world falls apart completely, and the unprecedentedness, just like it was crazy on the way up, we get something on the way down, I think it's worth at least giving 1 to 5% of your mental capital towards thinking about Bitcoin reaching quote unquote unprecedented price levels for anywhere from kind of 12 to 14K, with 20K being the first stepping point. I don't really know how useful this video is, to be completely frank. I just wanted to give some zoomed out, higher time frame perspective, which essentially amounts to either 30K holds in one form or another, and if it does, your entry between 31, 32, 33, 37, etc. won't fucking matter. But if it doesn't hold, yes, those positions, if you establish them and if they're clumsy, won't feel good. But if you survive and you end up in a once every few years opportunity to be buying quite exceptional price levels for Bitcoin and also for ETH, those are the types of conviction trades, if you follow them up with the appropriate strong-handedness, that pay for themselves, for quarters and maybe years to come. That's all I've got. Let me know if this was helpful at all. I just wanted to talk about something other than short-term price action. We did talk about short-term price action to like a very large extent with, essentially saying we're in a monthly bearish retest. That worked. So I thought, why not, given that the more obvious, if you will, or more technical move has played out, I just kind of wanted to rant and ramble a little bit about monthly structure and just high time frame structure as a whole, how I'm thinking about it, my base case, and also a tail case to be aware of. I would really love some feedback on this video. Let me know, leave a comment, leave a like, do all that stuff, and normal live streams coming back very soon. I just wanted to get this off my chest, if you will. Take nothing for granted, expect the unexpected, survive both sides of the vol spectrum, and you'll probably be fine. That's all from me. Take care.